Hey everyone, welcome back to the trading floor. Today, we're hitting the basics of Bollinger Bands. Let's get started. Bollinger Bands consist of a band of 3 lines plotted in relation to a securities price. The line in the middle is usually a simple moving average set to a period of 20 candles. The SMA serves as a base for the upper and lower bands, which are typically set to 2 standard deviations away from the SMA. This setup helps measure volatility by observing the relationship between the band's end price. While the 20-period SMA and 2 standard deviations are the most common settings, these can be adjusted by the trader. Make sure you test it out if you want to change things up from the default. There are several ways to use Bollinger Bands in day trading. One common method is to look for price touches on the upper or lower bands. When the price touches the upper band, it might indicate that the asset is overbought and could reverse downwards. Conversely, when price touches the lower band, it might indicate that the asset is oversold and could reverse upwards. Another way to use Bollinger Bands is to look for periods of high volatility where the bands widen and periods of low volatility where the bands contract. A particularly powerful concept within Bollinger Bands is what's called the Bollinger Band squeeze. This occurs when the bands contract tightly around the SMA, indicating a period of low volatility. A squeeze typically comes before a significant price movement. When the bands start to expand after a squeeze, it can signal the beginning of a new trend. Traders watch for those squeezes to anticipate potential breakouts. Bollinger Bands can also be used to confirm trends. In an uptrend, price will often move along the upper band, showing strong buying pressure. In a downtrend, price will often move along the lower band, showing strong selling pressure. By observing how price interacts with the bands, traders can confirm the strength and direction of a trend. Now let's go over a simple strategy using the Bollinger Bands. This strategy involves combining the bands with basic support and resistance levels. Here's how it works. First, identify the key levels. Start by marking significant support and resistance on your chart using whatever method you're most comfortable with. Next, wait for price to touch the Bollinger Bands themselves. When price touches the upper band near a resistance level, look for confluences to go short. When price touches the lower band near a support level, look for confluences to go long. Next, use price action to confirm the reversal. An entry pattern such as head and shoulders at resistance or a morning star at support can help you get into the trade after price touched one of the bands. Lastly, you can use the bands to monitor volatility. If the bands are contracting and it seems like you're entering a squeeze, be prepared for a volatile spike right after. Remember, like any strategy, it's essential to backtest and practice before trading with real money. And please, always manage your risk appropriately with something like a stop loss. If you found this video helpful, like and subscribe, and if you're interested in joining the trading floor, click on the link down in the description.